Have you ever wondered how to effectively manage your risk when selling stocks? Today, we're taking a deep dive into the world of stop limit orders. A potent tool in the arsenal of any seasoned trader, a stop limit order fuses the features of a stop order and a limit order. It gives you the power to sell a stock at a designated price, or even better, but only once the stock hits a certain trigger price. This dynamic duo of functionality offers you a greater degree of control over the execution price, making it a key player in mitigating risk. So, whether you're a seasoned stock trader or just starting out in the trading arena, understanding stop limit orders will help you navigate the choppy waters of the stock market with greater confidence and finesse. By the end of this video, you'll have a clear understanding of how to use stop limit orders to manage your risk when selling stocks. A stop limit order has 4 key components: the trigger price, limit price, quantity, and amount. First up is the trigger price, also known as the stop price. This is the price that activates your order. Think of it as the tripwire in a booby trap. Once the stock's market price reaches this level, your stop limit order springs into action. For instance, if you set a trigger price at $50, the order activates when the stock hits that price. Next, we have the limit price. This is the minimum price at which you're willing to sell the stock. After your order is activated, it will only execute at this price or higher. To put it in perspective, if you set a limit price of $49, the order will execute at $49 or above, but only after the trigger price is reached. The third component is the quantity. This represents the number of shares you intend to sell. If you're selling 100 shares, for example, your order applies to 100 shares. It's as simple as that. Last but not least, we have the amount. This is the total value of the shares being sold. You calculate this by multiplying the quantity by the execution price. So, if you're selling 100 shares at $49 each, you're looking at an amount of $4,900. In a nutshell, a stop limit order is a strategic tool that allows you to control when you sell your stock and at what price. By setting a trigger price and a limit price, you determine the conditions under which your order is activated and executed, respectively. The quantity and amount help you manage how much of your portfolio you're willing to sell at the given prices. Understanding these components is the foundation for setting stop limit orders. By mastering these, you're well on your way to making more informed trading decisions, effectively managing your risk, and potentially maximizing your profits. Now that we've covered the components, let's dive into how to set a stop limit order. First, you need to determine your trigger price. This price should be based on your risk tolerance and the market analysis you've conducted. It signifies the stock price at which your stop limit order becomes active. For instance, if you set a trigger price at $50, the order activates when the stock hits that price. Next, you must decide your limit price. This is the minimum price at which you're willing to sell the stock. After the activation of your stop limit order, it will only execute at this price or higher. For example, with a limit price of $49, the order will execute at $49 or above, but only after the trigger price is reached. Now let's talk about quantity. This refers to the number of shares you intend to sell. So if you're planning to sell 100 shares, then the order applies to those 100 shares. Lastly, you need to calculate the total amount. This is the total value of the shares being sold and is calculated by multiplying the quantity by the execution price. So, selling 100 shares at $49 each results in an amount of $4,900. Once you have determined these key components, you can place your stop limit order with your brokerage. You'll need to specify the trigger price, limit price, and quantity. Remember, the order won't immediately take effect. It will remain dormant until the stock's market price reaches the trigger price you've set. Once that happens, your stop limit order becomes a limit order to sell at the limit price or better. This is a strategic way to manage your investments. You're setting specific conditions for selling your stocks, which can help you manage risks and potential profits more effectively. So, that's the process of setting a stop limit order. In our next segment, we'll discuss the activation and execution of these orders in more detail. The order remains dormant until the market price reaches the trigger price. What happens after you've set your stop limit order? Well, it's a game of wait and watch. your stop limit order remains dormant like a sleeping dragon until the stock's market price reaches the trigger price. Once the trigger price is hit, the dragon awakens and your stop limit order leaps into action, transforming into a limit order. Now, it's ready to sell at the limit price or better. Think of it like setting an alarm clock. The alarm, your trigger price, is set, and the clock quietly ticks away until it's time to ring. When the alarm goes off, it's time to get moving. Your stop limit order is activated and ready to execute. But bear in mind, the stock market isn't as predictable as an alarm clock. The execution of your order isn't guaranteed. It will only occur if the stock can be sold at the limit price or higher. So if the market price takes a nosedive and falls below the limit price after triggering, the order won't execute. It's like setting the alarm, but the electricity goes out before it can ring. This is the beauty and the beast of stop limit orders. They provide control over the selling price, but there's no certainty of execution. It's a tool that can help manage potential losses and maximize profits, but it's not a magic wand. However, remember that there's no guarantee of execution if the market price doesn't reach the limit price after triggering. Utilizing stop limit orders presents both advantages and limitations. One of the significant benefits of using this type of order is the control it offers. By setting your trigger and limit prices, you decide the minimum amount you're willing to accept for your shares. This level of control can be particularly beneficial in volatile markets, where prices can fluctuate rapidly. A well-placed stop limit order can help you manage potential losses by setting predefined selling conditions. However, it's crucial to be aware of the limitations associated with stop limit orders. While they offer control, they don't guarantee execution. If the stock's market price doesn't reach your limit price after the order is triggered, the order won't execute, and you may miss the chance to sell your shares. Another consideration is the speed at which market prices can change. In a rapidly declining market, the stock price might bypass your limit price before your order can be filled, leaving you with unsold shares. Despite these considerations, the strategic use of stop limit orders can be a valuable tool in your trading arsenal. They offer a way to manage risk while retaining control over the selling price of your stocks. Understanding and effectively using stop limit orders can enhance your trading strategy by allowing you to set specific conditions for selling your stocks.